Hello and welcome. People think renting a house is as good as throwing your money away and that buying a house is always better. Not necessarily. In the current environment, it's probably better to rent than buy. I'll explain how. Home ownership is such an important part of the culture. Not just in America, but also in India where I grew up. Should I buy or rent a house is not even a question we consciously ask. It automatically becomes a goal of ours. It was mine for a long time. For a long time, it seemed like an obvious choice between buying and renting. Why pay rent and have nothing to show at the end of it when you can pay the same amount towards a mortgage and build up some equity in it? Since the housing prices are going up, you can benefit from the capital gain. Even if the prices does not go up, you will still have some equity in it, right? And it's better than renting, isn't it? Let's look at the numbers and see why renting makes a lot of sense. We'll compare the net worth of two individuals after 25 years, whose financial condition has been same in every way at the beginning and during the 25-year period. Except that one person buys a house and the other one rents a house in a similar locality. We have two friends, Bhim the buyer and Ramaraju the renter. Each has $70,000 lying in their bank account, and for the time being they don't have any liabilities. So their net worths are $70,000 each. The difference is that Bhim, who's more conventional in his thinking, wants to buy a house, but Ramaraju, who enjoys the freedom that comes with renting a house, wants to rent. Let's start with Bhim. I'm taking the current numbers in Brampton, Ontario, but you can replace those with the numbers in your locality. I'm happy to share the spreadsheet I've used to calculate these. Let me know in the comments below. Bhim wants to buy a $1 million house that comes with 4 bedrooms and 3 bathrooms. A 5% down payment is $50,000. So that means he needs to borrow $950,000. Mortgage default insurance is 4% of the value of the property, which is $38,000. That gets added to the value of the mortgage. So his starting mortgage value is $988,000. There are a lot of numbers here, so I'm just going to read some of these numbers. A 5% down payment is $50,000. The provincial land transfer tax is $16,475 in Ontario. There's no additional municipal land transfer tax in Brampton, and as a first-time home buyer, you are eligible for a rebate of $4,000. So the effective land transfer tax is $12,475. Provincial sales tax on the mortgage default insurance is 8% in Ontario, which is $3,040. Legal fees are assumed to be $1,000. Title insurance might be $250. The home inspection fee is $500. Government registration fee is $200. And home appraisal fees might be another $300. That's a total of $67,765. It almost eats up Bhim the buyer's $70,000 in cash, but now he has another asset, the house worth $1 million, and a liability, the mortgage worth $988,000. His net worth now is $14,235. Ramaraju the renter doesn't have any upfront costs. He just needs to find a place to rent and sign a lease. He finds out that the house next door is identical to the $1 million house, but is renting for $4,000 per month. So at the beginning of the year, his net worth hasn't changed and is still $70,000. Because of the large upfront costs associated with buying a house, Bhim's net worth is less than Ramaraju's at the time they got the keys to their new houses. Now let's look at the ongoing cash flows. Let's assume that Bhim the buyer can get a 5.1% fixed rate mortgage for a 5-year term. His mortgage payment will be $5,833.5 per month. His maintenance and repairs on the house comes to $1,041.70 per month, assuming an annual rate of 1.25% of the home value per year. Property taxes in Brampton are almost 1% per year at 0.962669% currently, for a monthly cost of $802.20. Property insurance might start at $100 per month. That gives Bheem a total monthly cost of $7,777.30. Over the next 25 years, the interest rate on his mortgage may go up slightly for future 5-year terms. Ramaraju, the renter, only has to add $50 per month to his total for renter's insurance and he's good to go. His total monthly commitment at this point is $4,050 per month. We'll assume his rent increases every year with inflation. Now, to make a mathematically apples to apples comparison, we need to factor Ramaraju, the renter, committing the same cash flow per month to his overall situation. So we subtract Ramaraju's monthly obligation of $4,050 from $7,777.4 to get $3,727.35. So Ramaraju, the renter, will pay $4,050 for monthly rent and commit $3,727.5 to also buying an asset, which in this case I've assumed to be an investment portfolio. Let's fast forward 25 years and assume that both Bheem and Ramaraju are leaving Canada for their home city of Hyderabad, India. Bheem, the buyer, sells his house and his gain is tax-free. Ramaraju, the renter, has paid taxes on the investment distributions all along and has a capital gain upon selling his investment portfolio. I've assumed that he invests in a low-cost Vanguard fund with a dividend yield of 1.6%. How do their net worths compare now after 25 years? Was renting just a waste of money? As you might have expected, a lot depends on how fast the housing prices and the investment portfolio have grown over the years. I've assumed that the expected returns on the investment portfolio will be 7.5% after inflation. I got these numbers from BlackRock. It's an asset management company that manages $10 trillion. It's the largest asset manager in the world. Assuming an inflation of 3% per year, the real return is 4.5% per year. I've also assumed that the Canadian housing prices over the next 25 years will grow at an annual rate of 3.5% after inflation. So the real growth rate in housing prices is 0.5%. So essentially I've assumed that the housing prices will just keep up with the inflation. I've got this number from TD Economics. 3.5% might seem like a low number, but the last few years have really been an exception. Home prices cannot continue to grow at the levels they have over the past few years. Remember that housing prices in Canada have had a bull run for almost the past 2 decades. Canada's housing prices did not correct during the financial crisis of 2007 and 8 like they did in US and the other rich countries. Using these numbers, we find the following. Bheem, the buyer's house, is now worth $2,363,244.98. He has no mortgage left, so selling his house would cost $118,162.25. After tallying up a 5% realtor's commission, GST and legal fees, that leaves him with $2,245,083.98. Ramaraju, the renter's portfolio, has grown to $2,977,795, and that's after subtracting the tax drag of distributions paid along the way. I've assumed that as soon as he gets his dividend income, he'll pay a marginal tax of 39% and reinvest the remaining in the same fund immediately. He had no mortgage to begin with, so his liabilities remain at zero. But upon sale of his portfolio, he has to pay tax on the capital gains of roughly $381,216, leaving him with $2,596,579. So after 25 years, Ramaraju the renter is $350,000 ahead of Bhim the buyer. Just to emphasize the point, by renting and investing the saving in the stock market, after 25 years, the net worth of Ramaraju the renter is $350,000 more than Bhim the buyer. So there you go. Renting does not necessarily mean throwing away money. If you're disciplined in your investing, you can increase your net worth, sometimes more than you would if you buy the house. But let's take a look at how changing a few variables can dramatically change the results. What if Bhim moves a few times and buys a new house every time he moves while selling the old house? If he moves 2 times over the next 25 years, the transaction costs, the sales commission of 5% on sale and startup costs of about 3% will bring his net worth down to $1,965,402, which means Ramaraju the renter would be further ahead. His net worth would be $631,178 more than that of Bhim the buyer at the end of the 25-year period. Now what if Ramaraju the renter doesn't save as much as he should have? He might think that he'll save the full difference each year, but it's a lot easier to skip a voluntary contribution to a portfolio than it is to skip a mortgage payment. If Ramaraju manages to save only 50% of the difference between owning and renting, his ending net worth drops to $1,298,287, which is $946,796 less than Bhim the buyer. Or what if Ramaraju's portfolio only grows by 5%, but he manages to save diligently? He still loses as he ends up with $1,844,237. We often think that renting a house is as good as throwing that money away. We think buying a house is better. But that's not true always. We often underestimate the cost of owning a house. We ignore the transaction costs, which is often 8% of the value of the property. We ignore the day-to-day costs of running a property, repairs and maintenance, property taxes and property insurance. And finally, we underestimate the opportunity cost of owning a house. The money that you put towards down payment and the principal portion of the mortgage payment you make every month can and often does earn a higher return when you invest it in a stock market. Historically speaking, in the long run, the stock market has always outperformed the housing market. The housing market has barely kept pace with inflation. As we saw in the above calculations, under present circumstances, with high and rising mortgage rates and crazy high home prices, you're better off renting a house than buying it. Buying a house does make more sense than renting if the home prices and the mortgage rates are less. There is a simple rule for it, the 110 rule. If your house price is more than 110 times your monthly house rent, it's better to rent the property. If it's less than that, it's better to buy. In the above example we worked out, the monthly house rent was $4,000. 100 times that is $440,000. But the current house price at $1 million is way above that, which is why it makes sense to rent it. But in the long run, both buying and renting the house cost about the same thing, and that is what the economic theory would predict. Renting a home and buying the right to not to have to rent a home are economically equivalent actions. As you can see, variables, many of which are unknown in advance, influence which strategy works out the best. That being said, remember these two things when deciding whether to buy or rent. Number one, know thyself. Are you the kind of person who enjoys the freedom that comes with renting a property, knowing that you can move whenever you want? Or are you the kind of person who gains a lot of satisfaction from owning a property? A lot of people rush into home ownership and end up moving after a few years, or even more often, and it's not a financially sound thing to do. Home ownership actually does economic damage in a more subtle way too. Indebted home buyers are 30% less likely to become entrepreneurs, according to a study. When you have a mortgage payment to pay, you are less likely to take risks with your career. How disciplined can you be to invest the difference between the cost of owning a house and renting it? We often think we'll invest all of the difference, but we often end up spending some or all of it. If you don't think you can be that disciplined, first of all, congratulations. It's a huge accomplishment to know and acknowledge that. Buying a house probably makes more sense for you. It provides a forced saving mechanism, and you also end up with the satisfaction of owning a house. Number two, know the real estate market. Be mindful of the transaction costs of buying and selling a property. And also be mindful that in the real world, housing prices and your investment portfolio will not go up in a straight line in a linear way. The real world fluctuations are a lot harder to handle. Your projections can go out of the window very quickly. This is Sarath Mantravadi. Thanks for watching.